Hello friends, welcome to my YouTube channel at Raj Kamal. As you go through this video, do subscribe and press the bell icon so that you can get updates on new videos as they are posted on this channel. The last week was a pretty interesting one for markets with very limited data, but a lot of central bank news with significant implications. At an overall level, the markets rallied, and that too despite being a short week given Labor Day. As you can see on this chart, the Dow Jones Industrial Average went up 2.66%, S&P 500 was up 3.65%, and NASDAQ was up 4.14% for the week. And also Tuesday was a down day, so that is a significant jump for the week. Crypto markets also rallied hard, and you can see over here that BTC went up 7.8% for the week. See another chart for ETH here, and that's up 10.4% for the week. Other cryptos have also shown bullish pops, especially in the last 48 hours. Interestingly, this pop has happened in spite of a hardening in treasury yields. The 10-year treasury yields are actually at 3.33% now, up 6 basis points since Wednesday. And the 2-year treasury yields are at 3.56%, up 11 basis points since Wednesday. So markets are rallying, and in fact, NASDAQ is rallying the hardest of them all, in spite of rate increases, and that's pretty unusual. So what's been the driver to market performance this week? Well, the biggest driver was the speech given by Fed Chair Powell on Thursday, where he reiterated the Fed's hawkish policy stance and actually said, and I quote, "The Fed has and accepts responsibility for price stability." In fact, the Fed's hawkish stance has been reinforced by Brainard and other Fed speakers in the last couple of weeks. The CME Fed Watch Tool Index immediately popped and raised the expectations for a 75 basis points hike in the September 21 meeting of the Fed. The odds for a 75 basis points hike now stand at 91%, as you can see on this chart, and this is up from 57% just last week. The hawkishness in the Fed was also seen in other central banks. The ECB actually did a surprise jumbo rate hike of 75 basis points on Thursday, and this on the back of 50 basis points hike in July. These are the first rate increases by ECB since 2014, where they have actually maintained a negative 50 basis points deposit rate for 8 years from 2014 to 2022. So what could be driving the market pop in spite of strong treasury yields and very hawkish central banks? For one, the US dollar has come down. But that is marginal because the USD index is still at 109 and hovering near 20-year highs. The second reason could be that markets see extreme pessimism as a contrarian signal. And indeed, the AAII Investor Sentiment Survey came out at one of its most bearish readings this week. As you can see on this chart, the bullish sentiment in AAII came at 18.1% and bearish at 53.3%, implying a negative spread of minus 35.2%. This is one of the lowest readings, and even for a year as bearish as 2022, this is really low. Such pessimism in the past in AAII investor sentiment has been contrarian and pointed to bullish markets 6 months out. The third reason is that with the 75 basis points rate hike now fully priced in, the market is looking beyond. The expectation is that the Fed will wait to see what happens in October and November, and if inflation begins to cool off, there may not be the need for further jumbo rate hikes or even such Fed hawkishness. And the market will try to spell out things of such a change in Fed attitude ahead of time. So is the coast all clear? Not really. Next week data will have CPI on Tuesday, PPI on Wednesday, and retail sales on Friday, all of them pretty market moving. If the inflation reading indicates a peak inflation narrative, and if retail sales are not super hot, then the market could continue on this bullish journey. If there are surprises, there may be a reversal. In any case, I think market analysis is not about always painting a doomsday scenario. Doomsday scenario painting gets eyeballs, but that's not what I am here for. I actually think that the lows of the current cycle are already in. See this chart on S&P 500 and you will clearly notice that the downtrend that started in January this year has now been replaced by an uptrend since mid-June, and we are seeing higher lows. These technicals don't indicate that we have a big downside ahead. Yes, things could go wrong, and they could always. But the weight of evidence is not towards another bottom. Thank you.